down 77% in 2022. Is Fastly stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. First, let's look at the edge computing company's revenue growth over the recent few years, and I'm looking at quarterly year-over-year growth. And most recently, it re-accelerated its revenue growth, which has gotten investors a little more excited about the stock. The revenue growth fell less than 20%, and then it's been steadily increasing since then. The rate of growth is increasing. Of course, it was growing much faster in 2020 before the outbreak. Revenue was growing as much as 60%, but has since slowed down. And so since the company's growing so rapidly, I want to look at operating income to see if there's any evidence of growth here in operating income, and we're not seeing any of that. In fact, we're seeing operating income heading in the wrong direction, and it's just been going downward ever since 2019. Operating income is down, and in its most recent quarter it lost 65.77 million. So it's not making any money, and as its revenue growth is increasing, as it's getting a bigger revenue base, it's losing more money on the bottom line. This is not the direction I like to see the companies that I invest in going, so this is not good news for Fastly stock investors. So next, let's look at cash flow from operations, because as you might already know, tech companies sometimes lose a lot of money on the bottom line, but they still generate cash flow because of paying stock-based compensation. But that's not even the case for Fastly here. It's losing money even in cash flow from operations. Losing 27.6 million in the most recent quarter, and it's lost money in 1, 2, 3, 4, 5, 6 consecutive quarters. It's negative cash from operations. So things are not looking good for Fastly here. So since it's losing so much money, I was concerned about this company. So I pulled up its cash and equivalents to see how long it can sustain itself, and it's got only 88 million in cash and equivalents. So at this rate, if it keeps losing 28 million per quarter, it's only got about 3 or 4 quarters of between 3 and 4 quarters of cash flow left. It's got to do something to raise some cash here, and alleviate this cash burn as well. This is not looking good for this company. So finally, let's look at its valuation. The stock is trading at a price to sales of 2.46, and I had to use price to sales because the company is not consistently profitable on the bottom line, so I couldn't use price to earnings. The company was not generating consistent cash flow from operations, so I couldn't use price to free cash flow. So I chose to use price to sales ratio to simplify things. I didn't want to go to the enterprise value metrics because I feel that complicates things a little bit. So let's use the price to sales, and according to this metric, it's trading at a price to sales of 2.46, the cheapest the stock has been going back all the way in its young history. But that's not surprising to see, considering that its revenue growth is down from its highs, its operating income is the most negative it's been, it's going in the wrong direction in cash from operations, and it doesn't have very much cash on the balance sheet. So these are all negative signs for Fastly stock. So you are probably not going to be surprised to hear the recommendation. I'm going to say that the stock is not a buy for 2023. The company, I feel, needs to turn things around before investors can feel like it's a prudent investment. All right, that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.